if what Elon is going to do at Twitter is accurate, that he's going to cut so deep, he's going to cut 30, 40, 50% potentially of the employee base, it really sets a new standard for how profitable a tech company can get. When you cut 30, 40, 50% deep, and you can actually turn a real profit on a business, an enterprise scale business, like a Twitter or like many other enterprise software companies that are out there right now, it really kind of sets a new standard that a lot of folks might then end up saying, you know what, maybe we should go deeper.
Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits.
This is Chamath Palihapitiya, former executive at Facebook, CEO of Social Capital, owner of the Warriors, and billionaire in his own right. He's talking about why all of the people who just lost their tech jobs. It can be scary to lose your job. A lot of my clients have just lost their jobs as well. But he's going to explain from a business perspective why this decision was made and how this decision will impact future tech jobs going forward the next 3 to 4 years.
I think this is the beginning. This is not even...
Unpack it.
Well, I think that if you take a very balanced view of what happened this week, you have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. And again, without debating whether, that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that, the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits.
Essentially what he's saying is as the risk-free rate of return or the interest on these government bonds goes up, because the federal government is considered to be the quote-unquote risk-free rate of return because it is the least likely to default. Essentially what he's saying is as these numbers go up, companies need to make more and more profits as far as their stock is concerned, because company stock is not risk-free. Anyone who bought FTX or, any other company that is tanked knows that there is absolutely risk when it comes to purchasing shares of a company. These are speculative products that could go up a lot or could go to zero. So in practice, what's happening, especially with Twitter, is these companies are realizing that this is not going to be a great time. There's not a lot of market confidence. A lot of people are going to be pulling their money out because of the risk, because of the increased interest rates. And in order to combat that, they need to be as profitable as possible. Unfortunately, for a lot of employees, when it comes to being as profitable as possible, that means laying off the employees who they deem to be expendable. Now, I'm not the arbiter of truth in who is expendable and who is not. I have no idea what people are doing at work. But at the end of the day, they have the power. They're making the decisions, and this is what they think to be the right play for their company.
Think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%. Risk-free rates are 5%.
Yeah, so I think this is that moment where you see that pivot from growth to profit.
Yeah.
And, we've been talking about it for 6 months, but this is how it is manifest in Silicon Valley companies of scale is through layoffs and cost reductions and cost savings. If what Elon is going to do at Twitter is accurate, that he's going to cut so deep, he's going to cut 30, 40, 50% potentially of the employee base, it really sets a new standard for how profitable a tech company can get. When you cut 30, 40, 50% deep and you can actually turn a real profit on a business, an enterprise scale business like a Twitter or like many other enterprise software companies that are out there right now, it really kind of sets a new standard that a lot of folks might then end up saying, you know what, maybe we should go deeper.
Essentially what they were saying there is that there are types of companies, growth companies, that their main point is not making money. If you were wondering why, Uber and companies like that have never made profits, and yet people still invest quite heavily into them, the reason is that there is some goal that they are trying to get to before they can make a profit, right? A lot of startup companies do this. They make an idea that isn't profitable, but they hope that they can sell that idea and that company to someone else who will then in turn make them profitable. In Uber's case, they know that they're losing money hand over fist, so what they're trying to do is over-invest into self-driving cars. If you live here in the Bay Area, you see those stupid-ass self-driving cars that are so annoying, and I hate them so much. But what they're trying to do is eventually their self-driving cars will be so good and so advanced that they can control the market, beat out Tesla, beat out these other AI companies that are trying to develop it. And that is the point where they become profitable. But because of the way the market is going, with interest rates going up and there's more competition and there's more scrutiny, and then, Elon's, of course, shaking everything up, it's harder to justify that to investors, to shareholders, to the common person who's looking at this company and they're like, why aren't they making any money, right? So essentially what's going to happen is these types of growth companies, Meta for a large part is a growth company. Everyone knows and hates the metaverse, but they're not making money on it. Are they going to dial it back? Well, probably not. So what's the best way to do that? That's to cut employees, because employees cost a lot of money, and a lot of money isn't exactly what these companies have right now. They want to be as profitable as possible, keep the people going, keep the money going, unlike FTX, which is going down thanks to B-roll footage.